I'm going to take you through a quick presentation from the perspective of a service provider. So I'm coming from the sort of solutions end of the title of this event rather than the investment end. Now certainly Reviva Capital isn't the household name in this industry that Ernst & Young and some of the other names sitting on the panels are, so I'm going to take the liberty to give you a little bit of an introduction of what it is that we actually do. It puts it into context. As I said in my introduction, we are a specialized asset manager. We deal solely with workout management and recovery processes. We have 1.5 billion euros of asset under management, two major primary portfolios, and I will talk you through one of those portfolios and use that sort of as a case study of our learning and dealings over the past years. We've been at this for the last 4 years, so for the entire duration of this cycle, and our clients are basically banks in wind down or any sort of bankruptcy proceedings that have either voluntarily or involuntarily taken the route that Matthew mentioned, sort of the asset management box that he mentioned on his scale, and I'll talk you through why that is the case. The asset classes that we deal with ranges from senior, junior, mezzanine, and to equity. It's all real estate with primary focus on Germany, UK, and the Nordic markets. The case at hand is basically a real estate loan book that has the attributes that you see on the screen. And if we talk you through what those sort of key attributes are, this is a loan book of nominal value of 1 billion euros. The number of loans are 185 to be exact at the beginning. The performance ratio was appalling at the starting point. We had only less than half performing according to the interest and amortization schedules, not mentioning the loan-to-value covenants and other more soft covenants. It had a 40-60 senior-junior mix, so 60% being junior, which immediately puts it into a sort of distressed type loan book at the time. 100% real estate backed in a relatively mixed pool. 45% residential, 20% commercial, and 35% mixed, spread around several markets, but as I said, concentration of this particular pool being the Nordic countries, Germany, and the UK. We've gone through what I call major restructuring cases, about 40 cases. We don't call a simple extension or enforcement process a major restructuring case. This would be a multi-month or multi-year process involving anything from 2 to 20 other creditors and a significantly complex corporate structure. Third-party debt involved, this is an important component. Those are the senior lenders to the junior situations that we are dealing with. That's about 1.1 billion, and this includes many of the household names of the European and UK banking sector. Now, if you look at these sort of parameters, this could very well be one of the Irish books that are coming to market. If you're looking at them, whether they are Harrogate or Kildare or Pivot or Pit Lane or whatever they call them, this is pretty much how they tend to package them up. So they seem to range from 500 to 2 billion in terms of nominal. The number of connections seems to be sort of anywhere from 50 to, let's say, 200. And this is sort of how the vendors and their investment bank advisors seem to be packaging them up. So I think what makes us an interesting case study here is that we've been going through this now for the last 4 years. This could very well be the starting point for an investor in this room who might be bidding for a portfolio, whether of this size or any smaller size. So the initial strategic considerations very much sort of reflect what Matthew said earlier. At the beginning, the current asset owner looked at maybe 3 options, and I was there at the time and responsible for that process. One was immediate divestment, and bear in mind this was in late 2008, where we started this journey. Some sort of an operational partnership with a capital-rich operator that could provide support in terms of market knowledge and capital injections as needed, or creating an own operational platform, basically running the own asset management strategy and run the process independently, you could say. The portfolio was actually taken to market in a very structured way in late 2008. We had about 15 bids from very serious bidders, the very same names as are now bidding for the Irish and UK books. The bid range was from the low side of 15 cents on the euro, cash, to the high side of 50% vendor financed, and then anything in between. So clearly these were not necessarily so attractive at the time. They might actually be attractive today to some of the vendors simply because of the quality of their assets and the current situations that they are in, but at the time it's not seen as attractive. We didn't necessarily manage to locate a capital-rich operator at the time. There was a sort of scarce resource, especially not somebody that had the market reach on the markets where the assets were domiciled. So in the end, the decision was made to pursue option 3, and that's sort of the journey that we've been taking since. The initial consideration, and this might be the situation of an investor who just acquired or just won the bidding process, going from a 10 to 15 people long list to a three company short list to be in the winning bidder of a portfolio. And as I see it, many of them haven't necessarily considered what happens next after the assets exchange hands, and how we're going to then maximize the recovery. What process are you actually going to be running? And some of the learnings from our past is a very important first point is to segregate and stabilize the operations, secure sustainability basically in terms of the way you run through this process. Secondly, you need to reset the team. The original team that originated and underwrote those loans are almost by definition not the best people to deal with problems that have then risen. There can be exceptions to that naturally, but sort of from a team perspective, that's normally not the case. And then the important part of what to work on internally, what to reach for outsourcing arrangements. And there is a balance there, and this is not a black or white. As an example, we have recruited, which is not good for David and his company, but we've recruited in-house lawyers to deal with things that really can't be justified to outsource. But we use out-house local jurisdiction lawyers wherever is needed, and to have in-house persons of sort of with legal skills and legal background to operate and run those processes is tremendously important, both in terms of efficiency and cost naturally. The teams need to be incentivized, and this is a completely new setting. Here, the original asset owner, the bank mentality might be to minimize loss. Here, the mentality needs to be to maximize value. These are completely two different things, and you both sort of assemble the team of certain sort of persons and characters and skill set, but you need to incentivize them towards that goal in mind. And very importantly, you need to adjust the timeline of their commitment to the timeline of the expected recovery timeline. And here, of course, it's a challenging role, because anybody in my position would realize that the more successful you are, the faster you're out of a job. So there needs to be a clear compensation component to adjust that. Infrastructure is another very important thing. Process management, the reports. At the core of it, bank systems are very ill-suited to run workout management and recovery processes. There can be exceptions, and some banks have done good investments in-house to tackle all of these parameters, but I'm afraid the general rule is that they have not, and are not interested in that, and do not have that sort of mindset, let's say. Analyze your data, a very important point here. We've had to go much deeper than a bank would normally do when operating a normal credit management, credit administration process, and focus needs to be much on the counterparties, whether it's the co-lenders or the borrowers, the operators of the assets, and much more on the underlying assets or the underlying cash flow, rather than on the sort of loan documentation or the covenants themselves, which in the end become a little bit immaterial and are simply your access and your gateway towards the actual value of the underlying asset. Now, in terms of the processes that we've sort of identified and are involved in this, I'm not sure you can read all the text on this slide, so bear with me. We've sort of approached this in a rather structured form, where we start with an assessment process, we then go into a restructuring, then a stabilization process, and sort of between stabilization and divestment, there is an operation, there is a sort of timeline, of a cool down, if you want, where we try to operate the asset in a stable mode before eventual divestment takes place. And this is just to identify some of the activities that are undertaken and needs to be undertaken across the spectrum of this flow. And for the sake of time, I can't dwell too long on it, but what I wanted to sort of demonstrate or exemplify here is sort of how we've actually come down this waterfall or this sort of process over the last 2 years or so. And the experience sort of tells us that the initial assessment process is taking anywhere from 1 to 6 months. This is really to decide whether to go in and take control or to work with the borrower if the borrower is capable of supporting the asset and is sort of cooperative. How to work with the other lenders if you can work with them, or whether simply leave this to rest and not spend time or effort on it. The restructuring phase typically taking 6 to 12 months, but we've seen cases taking up to 3 years, especially if it involves lenders that have been nationalized in their own jurisdictions, where sort of the internal management of the bank have lost the mandate to really take decisions, where we had bankruptcy proceedings or trustees across multiple jurisdictions. Things easily start to escalate into a year, a 2-year, and even a 3-year process of running through a restructuring. And during the restructuring, all the tools that you can imagine really apply, whether that's capital injections, debt to equity conversions, seizing control through legal or voluntary routes, etc. This is really where the crux of the action takes place. Once through that, you're either ending up with a re-performing loan, as you would call it, on new terms, or real estate owned, where you actually seize the underlying asset. And thereon takes a stabilization process where you need to do the necessary operational improvements, whether that is running CapEx projects, vacancy reduction projects, management changes, etc., or simply managing a performing loan. This is of course much easier if you can reach that point. Stable operation are important simply to create a track record and to distance the asset from the distressed realm and bring it back to a sort of normal going concern realm. This is about dressing up the asset and preparing the asset for sale. And then basically the exit point is packaging, a normal transaction mode of packaging, creating a data room, and bringing the asset to market and closing the deal. Naturally that can take anywhere between 6 and 12 months, hopefully not longer in a normal market. Now just sort of looking at where we stood in 2010, Q2 2010 is the sort of point here, and we've kept track record on the process here. At that point in time, we had 21% of the nominal value of the cases under assessment, 38% were being restructured, were sort of in that phase, 16% had been stabilized, only 3% were running as stable. That sort of means that they have already posted at least one interim account in a stable mode, the solvent balance sheet, etc. And we hadn't really done much exiting at the time, with few exceptions. In 2012, of course, what you would expect in a flow like this, that everything shifts a little bit right if things are going somewhere. Here, none of the assets were still under assessment. 42% of the nominal values, or 59 of the individual cases, still being in some sort of restructuring. Most of them moving towards the end of the restructuring. 21% in stabilization and 28% already stable. And so we are now moving towards an exit and a closing. So what's the current status of this particular case, coming from a 1 billion euro nominal and a very low bid range? We've liquidated 340 million euros of cash. That's coming in, of course, from borrowers that can actually refinance, from interest payments and amortizations, normally, of performing loans. From occasional exits where we sell actually loan tranches, mainly junior tranches where we cannot see any further value increase. So there have been successful exits so far. The remaining value is still in the region of €500 million to be monetized and recovered over the next 2.5, maximum 3 years, and with a total expected recovery range of 75 to 80%. The sort of dynamics of the asset portfolio today is basically that 80% are performing, but that's of course in many cases completely new terms, where a defaulted junior debt that we were managing has simply ceased to receive interest or amortization, and cash is being swept to the senior. So it is still performing, but not necessarily anywhere close to the original terms, naturally. And 250 million euros of those 500 that are still sort of a remaining value is now being completely controlled as real estate owned. So they have gone from being defaulted debt to becoming performing direct real estate holdings, and will be exited as such and not as loans. Key learnings on the operational side from our point of view, that banks, unfortunately, neither the staff or the infrastructure, are normally, and I emphasize normally, not well equipped for running this kind of a process. Retaining key staff and recruiting new staff with asset and transactional experience is crucial, but challenging, especially if you're in a wind-down process. That's why incentivizing and aligning the team is key. And basically to invest in the necessary infrastructure and get organized. And this is where we see a lot of organizations fail, especially in many of our counterparties. Now on the workout strategy itself, so some key learnings would be to be proactive, to basically be the first one on the site. That normally brings some sort of a first-mover advantage. And you can actually try to bring solution to the other creditors or stakeholders rather than to be a recipient of such solutions. To get your facts straight, this is amazing how both the original documentation as well as simply the monitoring has lacked in the last few years. So this is about going much deeper into the nitty-gritty details of the background of the transaction, etc. Go for voluntary arrangement before legal routes. Again, apologies. If you want to run a process that is sort of under your control and a timeline that is sort of reasonably well known in advance, especially if you're in a multi-jurisdictional situation, then clearly a voluntary arrangement should be the first route of action. If not possible, then of course the legal routes are the fallback plan. This is our view on that. And an important sort of from a banker's perspective. In this game, you need to think like the equity and not like the debt, because in reality, you are the equity, even if you hold a loan document in your hands.